Want to scale your D2C brand but doesn't have access to large financial resources? Well, today you can scale it with revenue-based financing. Let's check this video out. Hi friends, this is Harsh Mahajan. Let's get started. So let's first understand what is revenue-based financing is. Revenue-based financing is a model where you raise funds from the investors based on the future cash flows or predicted cash flows, and you pay a small percentage on every receipt of the payment back to your investors. So like for example, today you are getting a 3 lakh rupees of payment from Amazon. So it might be possible, let's say they will take 5% back to them, and rest 2.85 lakh rupees will be credited to your account. So a small percentage from your revenues is paid back to the investors, and rest money is transferred to you. So what is the beauty of the revenue-based financing model? The beauty is you don't have to give any personal guarantees, you don't have to give any kind of collaterals. Everything is based on your predicted cash flows, predicted revenues, future revenues you are going to generate, and you are paying only a small percentage fees, you can say, or amount back to your investors. So you are not going into any kind of a cycle where you are committing an X amount every month. You are just paying based on your revenues, and there is no equity dilution as such in it. So every control, there is a total control on your company with you only. So now let's talk about the companies who are providing the revenue-based financing. So revenue-based financing as a concept is nothing new. It's just that it has been revolutionized in a way now that there's an easy access to this kind of model for a small business owner or an emerging D2C brand or any startup. Primarily in India, there are 3 companies who are dealing into this model. First is Klub. So what Klub helps is, Klub is basically a platform where you as a brand going to list yourself that you want to raise say 1 crore rupee of investment. Then that listing goes live on their platform, and the potential individual investors or the HNIs or the institutional investors can invest into your brand. Here the key important point is you have to issue unlisted NCDs in the favor of your investors, and thus you have to pay a certain amount every as per the committed frequency. Second is Velocity. So Velocity is specifically meant for D2C brand owners and e-commerce brands. Here you can raise approximately up to 3 crore rupees for your marketing and advertising spends. Here you sync your Amazon data or your own platform sales data based on Shopify or WooCommerce, and they are going to give you an approximate figures, the amount they can lend it to you. And again, the money will be deducted either from your Amazon account or directly from your payment gateway, and the rest will be credited back to you. Third, we have GetVantage. So GetVantage is pretty similar to Velocity. Basically, they say they are for the founders and by the founders. They have identical model just like Velocity. You are going to sync your marketing data and sales data and revenue data with them. Based on analysis, their engine will going to predict how much amount they can give it to you, and again a small percentage fee will be charged as the charges, and the rest money will be going to be credited back to you for each transactions you make. So what both Velocity and GetVantage helps you, they are helping you to scale based on the revenues you are generating. So today you are doing 10 lakh rupees sales, they are going to say give you another 10 lakh rupees. You can invest back that 10 lakh rupee in your brand, then you are going to say you are going to do 50 lakh rupees of revenues. Based on that 50 lakh rupees, they are again going to give you an X amount, maybe 20 lakh, 30 lakh. Then you can keep on rotating or increasing the amount at a certain time period, and you can use it to scale your brand. So that financing constraint which lot of small players used to have is now eliminated, and you have access to large financial resources which otherwise you don't have. And the timelines to go live with both these or both the companies, that it generally takes 1 to 2 weeks to get the funds in your account. So there is no huge amount of time which is spent, like 4 weeks, 6 weeks, or maybe months, which traditionally goes into a traditional debt raise in CC or OD, or typical equity raise model. Now the most important part is whether you should actually invest. You should actually raise funds using revenue-based financing model or not. Well, I'll give it a thumbs up with yes, with a lot of caution, because essentially you are paying both principal and interest at a very shorter period of time. In the traditional models where you raise money or raise debt via CC or OD, you generally end up paying a monthly interest on the amount you have used. You don't generally pay back principal instantly in a shorter period. In most of the cases, CC and ODs keep on revolving, and you keep on getting enhancements or something like that. But in revenue-based financing model, you are essentially paying back the principal and the interest back to your investors in a comparatively a shorter period of time, maybe 6 months, maybe a year. Though these companies will also going to follow the revolving credit lines, but essentially model says that based on the revenues, a percentage is deducted which contains both your principal and interest, and it is being repaid back to the investors. So there is a lot of caution which is involved in it. You don't have to just directly jump into it, because if you are taking this money and investing to buy fresh inventories or stock, and your inventory turnaround cycle is very high, then you might feel that financial burden or strain in paying back every time to this company. So use this model to actually scale it up where you want to expand your business. Use it for MAD, that is marketing, advertising and distribution. Use it to run your PPC campaigns, your Amazon PPC campaigns, Google Ads,